So in this video, you will need a general understanding of the wheel strategy, okay? Selling calls and selling puts, as well as the Greeks. And if you do not, I have a free mini course. Just get down in the pinned comments, go check that out, and then come back to this video. If you're learning about the wheel strategy, okay, this is going to be very, very critical because it's a question that I get asked all of the time inside the Discord. Like, hey Brad, how do I choose my strike price for a covered call? How do I choose delta? Do the Greeks really matter? I want to answer all those questions, guys. And also too, pretty pumped on it. If you like to hold stuff, I just wrote all this down. You can get this on Amazon. I'll leave the link down in the description below. Or like I said, you can get it anywhere inside my Discord or even just free here on YouTube. But I know some people, they like to hold the book. So I figured I'd plug that real quick. So let's dive into it real quick. Like I said, you need a general understanding, but I've said before that when I am doing the wheel strategy, so this is not the buying side of options. This is going to be selling options to collect premium from the buyer. When we are selling covered calls, we're using 100 shares as our collateral. And when we write these calls, we are going to need to choose what strike price we want inside that options contract. And the strike price that we choose really determines if we are going to win or lose on this trade. I've done videos calling the covered call a win-win strategy. It gets criticized, but if you choose your strike price right, you really can't lose when you're selling covered calls. And the same goes for cash secure puts. I hear all the time people saying like, oh man, I'm in trouble with this cash secure put. You get to choose the strike when you write puts, right? So you should never feel in trouble when you are writing options because you have the control. You get to write the contract and choose your strike and choose the Greeks that align with the proper strike that you want. They kind of work together, and I'll show you them on two platforms. The first platform I'll show you is the one I'm currently using, and that is Webull, guys. They are upping their game every single day. And if you don't have a Webull account right now, they're giving 3 free stocks if you sign up for Webull using my affiliate link. Also, if you'd like to get some free crypto, if you activate Webull Crypto and make a transaction of $1, they'll give you some free crypto as well. So it's a platform that's definitely worth checking out, in my opinion. The other one that I will show you is where these Greeks and these strike prices are located inside the option chain on Robinhood. Right now with the markets going down, guys, I've been starting a lot with the cash secure put inside the wheel strategy. So I'm actually not holding a lot of stocks. With everything going down, things are at a better value and I'm able to choose strikes to really collect premium. But I did get assigned on one, and the one stock that I am holding 100 shares of is Camping World. We've gone at length. You can jump in the Discord if you're curious, like what stocks am I buying? I also talk about like the criteria for what stocks I choose, but I love dividend stocks. Congratulations to Camping World investors. They just raised up their dividend and they actually had pretty good earnings, but in this crazy market, even with good earnings, the stock began to tumble. But here's the first thing, choosing the strike price for the covered call. If I open Camping World and we look at it right here, along the bottom, you will see that my average price is $40.86. That means that for the 100 shares I bought, I averaged $40.86 per share. I'm going to call that my cost basis, okay? When you are choosing a strike price to win in a covered call, the only thing you need to think about is the strike price above that basis? Because if I say make it for $40 and it gets assigned, well, now I'm going to be selling my 100 shares for $40 when I paid $40.86 for them, right? I would lose 86 cents per share or $86 because the contract is 100 shares. On the flip side of that, if I were to make it $41, now I would sell my 100 shares at $41 when I only paid $40.86 for them. So I'm going to get the premium that I collected from the buyer plus that small amount of capital gain. The larger you can make your strike price above your cost basis, the more money in capital gains you will receive when you are assigned. When trading the wheel, you will be assigned one day. Now that fear of assignment, it kind of diminishes the longer you do this. When you first start the wheel strategy, you do not want to get assigned. It's like, it's psychologically, like you just don't want it to happen and you get more comfortable with it until later on. Like right now, I will write my strike price pretty much as close to the money as I can, as long as it's above my basis to collect a higher premium. But when you first start out, this is where the Greeks and where Delta can help you decide and kind of mitigate the risk if we know the rules of thumb and the generalizations that Delta give us. to see delta, what we need to do is we need to go into the options chain, okay? Now, depending on your broker, you'll be able to find this in a different spot. I actually have a tab for my options chain. So when I click that options chain and I type in the top, Camping World, it is going to give us this screen right here, okay? And this is going to be our options chain. We could see both calls, puts, whatever we want. I'm going to be making a covered call, so I'm going to be in a single option. Now, the expiration date is really up to you. It doesn't matter if you do a week. It doesn't matter if you do a month. It's really personal preference. I like to just do them weekly if I can. So the next weekly expiration will be March 4th. What I would do is I would click this, and here is the current share price, $30.11. Now, let's say hypothetically that your basis is well below $30, okay? But you're not really ready to get assigned yet. What you'll look for is you will look for the delta, and the further above the strike price that you go, the more, quote, out of the money that you go, the smaller delta becomes. And you could see it's really the only Greek that I put when I'm doing the covered call. Yes, understanding theta and time decay and all these other Greeks is important, but really for the covered call, we don't need to overcomplicate things. Delta should be just fine. Now, this isn't a hard, fast textbook rule, but it's a general rule of thumb that delta is the percentage that the buyer, the other person that we're working with, has of succeeding in this trade. So for example, when we're at the money, roughly 50-50, it can go the buyer's way or it can go our way. So when you get close to the share price, you'll see delta is pretty close to 50. Right now, this is saying that the buyer has a 40% chance, gives us a 60% chance. This says the buyer has a 25% chance, so that means we have a 75% chance, etc., etc. When you are first doing this, you can use delta. I like to say 0.2, right? Give yourself an 80% chance of success. Know that even with that 80% chance, things can go wacky as we've seen in the markets recently. You could still get assigned, but the further away from the share price you go, right, the more likelihood you're going to have of succeeding in this expiring worthless. But the give and take with that is the premium that you pay. As you go further away from the money, the premium also shrinks. Right now, I do not have a covered call out on CWH. Why? Because of that strike price rule of $40.86. If I go back to this, right now I'm only showing 20. Let's see if I can show 30. I have to go all the way to $41, which still doesn't even show. So let's keep going. This thing really has gone the wrong way for me. If I go up to the nearest strike price, right, the bid and the ask, it's pretty much saying that this is worthless, right? The delta is 0.02. That means that the buyer has a 2% chance. You have to fulfill this order, right? When you are writing contracts, you need a counterparty. So right now, I really can't write it because I would break my cardinal rule of it has to be above your basis. Could I get greedy and come down closer to the money and risk it? Go for it. I don't care what you do, but that's not something that I do. So when I am writing covered calls, I make sure that the strike price is above my basis, and then delta is wherever I feel comfortable inside that risk tolerance. For me, if my cost basis was $29, I'd be writing it right at 31. That'd be the end of the day for me. Let's look at this options chain on Robinhood. It's a little bit different, and I also have some wheels going on in that platform as well. So one thing that I am wheeling inside Robinhood that I do have a covered call on is VTI. Let's go and check what my cost basis is. That's rule number one. So right now my cost basis is $226.86. All right, so that's going to be my basis. If I, from here, this is where I have my shares, okay? What I did was I clicked on my shares. Then over here, I said trade options. We are going to want to sell, and we are going to want to sell a call. And I have to make sure that my basis is above 226. Now, VTI happens to be a monthly. So there's only monthlies going on. So my next available monthly date is March 18th. And we can see this -1. I already have one open. I can write these anything above 226. So the 225 was not an option for me. The next one was $230. Right now, that's paying a premium of $130. I'm not sure exactly what I got. I think I got a little bit less. Here is that call for 318 that I have. I collected a premium of $129. So I actually did a little bit better. And what we want is we want the value of this option to go down. So what I want by March 18th, I want VTI to stay below $230. And if it does, this will expire worthless. And then I will just repeat the process. If it does get assigned, then I'll go back and I'll just write a call. But unlike Webull, guys, there is no Greeks given here. So you might be saying to yourself, where are the Greeks? If you click the particular option, when you scroll over it, it'll start to highlight. If you click that option, it'll give you all the information you need. Right here, delta 0.21, a pretty conservative delta for trading this particular option. If we go one below it at 225.39, okay, these are both pretty good plays, which is kind of why I like doing the wheel with VTI. It's a nice safe investment in itself. And then with that, the deltas are pretty low. The premiums do not suck. Let's see what one thing above it is. What would 235 be? 0.19. So this would be really, really, really conservative at 0.19 delta, but you still can get yourself $45. Now you're like, Brett, $45 on 22 grand that you invested in these 100 shares? Yes, right? No one's gonna be buying Lambos off of collecting premiums off the wheel strategy, but it is nice monthly passive income. If you do this with a couple stocks, I just did a video. I cannot wait for the 20-to-1 stock split. If you did not see that video, I'll link it in one of the cards or something or down in the description. Got 5 shares. I'm looking forward to that and we'll be good to go. Let's say you already owned 100 shares of Google and you wanted to just do this. What we do is we'd go into Google. We would click trade options on Google. The next fourth, and you're like, okay, well, my cost basis right now is below the current share price. So I don't need to really worry about my strike price too much. I'm just scrolling down. So there's the current share price. So you're saying to yourself, all right, my current share price is below $2,689, which is what the current share price is, but you want to be conservative. So what you might start doing is start clicking around, looking for that conservative 0.2 delta. And then you'd see the premium, guys. The premium is really the last thing that I look at. So I'm going to look how far above the share price we can get with Google, the current stock price, to get to a nice conservative bet. So even at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 strikes above the money, I'm still at a 0.33, and this is collecting $2,105 in premium. Granted, if you had 100 shares of Google right now, that would be a huge investment, but that's essentially what I do. I look for my basis, I get to my basis. That's really where it ends for me because I have no problem writing at the money or close to the money and getting assigned. But if you're new, you might start clicking around and just looking for a smaller delta. I wouldn't go much less than 0.2, but somewhere in that 0.3 to 0.2 type of area, I think you'll be just fine, guys. I hope that helped. If it did, please give the video a thumbs up. Consider subscribing to the channel. If you want to jump into the Discord, start chatting with us about this or pick up the ebook, I'll leave that link down in the description below, and I'll catch you in the next video.